Autoliv's Q1 2026 earnings are out. The operational performance beat internal top-line expectations, but they actually missed consensus on the bottom line. Net sales hit $2.753 billion.
Right, which is a 6.8% increase year over year.
Exactly, or 0.8% if we look purely at organic growth. But then diluted earnings per share plunged 12% down to $1.88. And that drove some pretty noticeable initial volatility in the stock immediately following the print.
Yeah, and if we look straight to the full year 2026 guidance, management held firm on a completely flat outlook. They reiterated expectations of around 0% organic sales growth for the year.
0%.
Yeah, zero. Along with an adjusted operating margin sitting tightly between 10.5 and 11%, and operating cash flow of roughly $1.2 billion.
Okay, so for you, the retail investor trying to make sense of this report, we have a major paradox here. Imagine you run a movie theater, right?
Okay.
Total ticket sales worldwide are dropping. Fewer people are walking through the doors, yet somehow you're making more money on popcorn and soda than ever before.
Right, selling more per person.
Exactly. But when you go to check your bank account at the end of the month, your cash flow is deeply in the red. That is the Autoliv quarter in a nutshell. I mean, the top line is growing, the bottom line is shrinking, and forward guidance is completely flat.
It's a messy quarter on paper, for sure.
It really is. So today, in this deep dive, we are going to figure out exactly what is happening under the hood of the world's largest automotive safety supplier. Let's just start with the macro environment because to understand that flat guidance, we really have to look at how Autoliv is completely bucking current global automotive trends.
Yeah, you really cannot look at Autoliv's 0.8% organic growth in a vacuum. You have to compare it to the broader environment, specifically, global light vehicle production, or LVP.
Right, and for those maybe a bit newer to the space, LVP is simply the total number of cars and light trucks actually rolling off assembly lines globally.
Exactly. And according to S&P Global, global LVP actually dropped 3.4% in the first quarter.
Wow.
Yeah, so while the broader automotive manufacturing market is shrinking by more than 3%, Autoliv still managed to grow its organic sales by nearly 1%. That represents a massive 4.2 percentage point outperformance relative to the underlying market they serve.
So that is the movie theater selling more popcorn per customer. I mean, even though automakers are building fewer cars globally, Autoliv is just putting more of their product inside each car that does get built.
Right, the content per vehicle is going up.
But global averages can hide a lot of local volatility, right? If they are outperforming by 4.2 points globally, where exactly is that growth coming from?
The regional breakdown is really where the operational story takes shape, specifically in Asia. I mean, let's look at India first.
Okay.
Autoliv saw a staggering 38% organic sales growth in India during Q1.
Wait, 38%?
Yeah. They outperformed the local light vehicle production by an incredible 28 percentage points.
Hold on, 28 points of outperformance. That cannot just be taking market share from competitors. That implies a fundamental shift in the product mix itself. How does a supplier outgrow its own customer base by nearly 30%?
It is entirely driven by safety content per vehicle. As safety regulations tighten globally and consumer expectations rise in these emerging markets, automakers in India are simply packing more airbags and advanced active seatbelt systems into every single car.
Right, because historically, a budget car in India might have had, minimal airbag requirements?
Exactly, just the bare minimum. But now, government mandates and crash test ratings, they demand a much higher standard.
Yeah.
Autoliv is capitalizing on that regulatory and consumer shift perfectly. They're even investing capital into additional inflator production capacity in India right now, just to handle the future volume they see coming.
Oh, wow. So the Indian market is structurally maturing in terms of safety. But what about China? Because, the Chinese electric vehicle market is intensely competitive right now. There are massive price wars, and legacy automakers are losing ground fast.
Yeah, China is fascinating. In China, Autoliv outperformed the local LVP by 15 percentage points.
Okay, that's solid.
It is. But the underlying mechanics of who they are selling to is the real takeaway here. Overall, light vehicle production in China declined substantially, right?
Mm-hmm.
Global OEMs, meaning the traditional Western and Japanese automakers operating in China, they saw their production drop 8.5%.
Ouch.
And Chinese domestic automakers dropped 11%. However, Autoliv's sales to domestic Chinese automakers jumped by around 30%.
Wait, really?
Yeah, up 30%. And at the exact same time, their sales to those legacy global automakers operating in China dropped by about 10%.
That makes Autoliv a fascinating canary in the coal mine for the global auto industry. I mean, they are aggressively aligning themselves with the domestic winners in the Chinese market.
Precisely.
Instead of just, going down with the legacy global players who are bleeding market share over there, they just pivoted their supply chain to the local EV makers.
That is the crucial insight for investors. They outperformed the Chinese domestic automakers' production rates by 40 percentage points.
That's incredible.
It really is. That means they aren't just riding a wave. They are aggressively winning new contracts and increasing their footprint with local manufacturers like Chery and various other EV makers. That agile strategic pivot to the local winners is completely offsetting the structural declines they are seeing with their traditional global partners in that region.
Okay, but if they're winning so much ground in Asia with domestic automakers, why aren't we seeing that same explosive growth in their traditional airbag and seatbelt numbers globally? Because the core business segments are really just inching along.
Yeah, they are.
Airbags, steering wheels, and that only grew 0.7% organically, right? Driven by center and side airbags, but offset by declines in passenger airbags. And meanwhile, seatbelt products grew a slightly better, but still low, 1.1%.
Yeah, that sluggish global performance really comes down to a negative model mix in the Americas. Autoliv cited high light vehicle production growth in South America, which, traditionally requires lower safety content per vehicle.
Right, fewer airbags and simpler seatbelts.
Exactly. And combine that with lower content on some specific vehicle replacement models in North America.
Yeah.
And it just drags down the global average, even with the explosive growth we just talked about in India and China.
All right, so let's look at the financial paradox this creates. Because they are selling more safety tech per vehicle in these massive emerging markets, they are capturing share with domestic Chinese automakers, and all of this drove their gross profit up 10% to $526 million.
Right.
Gross margin actually expanded to 19.1%. So why then did the bottom line shrink? Operating income dropped 6.7%, the operating margin contracted down to 8.6%, and as we mentioned at the very top, EPS plunged 12%.
Well, the bridge between a growing gross profit and a shrinking bottom line usually comes down to operating expenses and timing, and that is exactly what happened here.
Okay, break that down for me.
Let's look at research, development, and engineering costs. R&D and E-net costs increased by $25 million compared to the prior year.
That is a massive jump in overhead for a single quarter. I mean, are they just burning cash on R&D projects that won't see the light of day?
It looks like bloat on the surface, but we really have to look at the mechanics of how engineering reimbursements work in the auto industry. Suppliers like Autoliv, they do heavy custom engineering for specific car models, right? And the automaker agrees to reimburse them for a portion of that engineering work. But if an automaker delays a vehicle program, that reimbursement check gets delayed and falls into a different quarter.
Ah, but Autoliv still had to pay their engineers today.
Exactly.
Yeah.
So of that $25 million increase, $11 million was specifically a hit from lower engineering income related to these timing effects.
So the cash is coming eventually. It just missed the Q1 cutoff.
Correct. And then add to that $5 million in higher personnel costs due to standard wage inflation and $4 million in negative foreign exchange translation effects. And you've accounted for almost that entire R&D jump.
Okay, that makes a lot more sense.
Yeah. And furthermore, they face some brutal year-over-year accounting comparisons. Q1 of 2025 had a one-time income boost of $15 million. That was related to recycled currency translation differences from divesting their idled Russian operations.
Meaning last year's Q1 looked artificially good on paper.
Exactly. And this year, Q1 2026, well, it had a negative $9 million hit, mostly from restructuring costs in Europe, the Middle East, and Africa. So when you compare Q1 2026 against Q1 2025, you are comparing a quarter burdened by restructuring and delayed engineering income against a quarter that enjoyed a massive one-time accounting benefit.
That perfectly explains the income statement, but I have to push back on the cash flow numbers here. Because you can write off the bottom line as timing and accounting quirks, sure. But negative $159 million in free operating cash flow is a bleeding wound for an industrial giant.
It looks really bad, I agree.
Operating cash flow was negative $76 million. Are we absolutely sure this isn't a sign that automakers are just squeezing them on payment terms and starving them of cash?
It is entirely fair to view negative cash flow as a red flag, But in this specific instance, it really is a working capital anomaly. The negative cash flow was driven heavily by a $349 million swing in operating working capital.
Wow, that's huge.
Yeah. To understand this, think of Autoliv's quarter like hosting a massive wedding banquet on the last day of the month.
Okay, I'm listening.
You had to buy all the ingredients and pay your catering staff up front, right? In Autoliv's case, at the end of December 2025, they had a very high level of accounts payable, which is money they owed to their own suppliers. During Q1, they paid down $134 million of those payables. That is the cash going out the door to pay the catering staff. Then, the wedding happens. Autoliv had an unexpected surge in sales, specifically in the month of March. The guests ate the food, it was a massive success, and the revenue is officially recognized on the income statement.
But the bride and groom have 30 days to pay the invoice.
Exactly. When you sell a massive amount of product right at the end of the quarter, you don't collect the cash immediately. It just sits on the balance sheet as accounts receivable. That late quarter sales spike increased receivables by $175 million.
Oh, I see.
So on paper, you made a fortune. But today, your cash register is empty. You have cash going out the door to pay down past debts, and cash failing to come in the door because those March sales just haven't cleared the bank yet.
Got it.
Management explicitly stated they expect these temporary working capital effects to reverse later in the year as those March invoices actually get paid.
That makes perfect sense. And if we look at the balance sheet, it actually supports that narrative because it remains incredibly strong despite the negative cash flow quarter.
Oh, absolutely.
Their leverage ratio, which is their net debt adjusted for pension liabilities in relation to EBITDA, it's sitting at 1.3 times. That is well below their target ceiling of 1.5 times.
The balance sheet is rock solid. I mean, they have $342 million in cash equivalents. Total equity actually increased by $283 million over the past year, and their return on capital employed is a very healthy 22.2%.
Yeah, you do not see numbers like that in a company facing a structural cash crisis.
No, you don't. They even paid a dividend of 87 cents per share in the quarter, which, is a 24% increase from last year, and they are planning $300 to $500 million in share repurchases for 2026. A management team does not authorize $500 million in stock buybacks if they are secretly worried about making payroll.
Right, which brings us to the most strategic part of this deep dive. With the balance sheet solid and traditional four-wheel safety content maturing in Western markets, management is aggressively pursuing new growth levers.
They have to.
Right, because if your core market is bound by global light vehicle production, and we just established that LVP is shrinking, you eventually hit a ceiling.
You really do. You have to expand your total addressable market. You cannot just sit around waiting for consumers to buy more cars.
Yeah.
You have to invent a new category for your technology.
And looking at the product launches from March 2026, Autoliv is going completely outside the car. They are jumping into the motorcycle and micromobility space.
This is such a cool move.
On March 12th, they announced a co-development with Yamaha Motor to create an innovative airbag system for the new Tricity commuter scooter. They specifically noted this moves safety solutions beyond high-end luxury motorcycles and makes them accessible to everyday riders.
And then, less than 2 weeks later, they announced their first complete wearable protection for motorcycle riders. It is a physical vest with an integrated airbag system developed with RS Taichi, which is a major motorcycle riding gear manufacturer.
An airbag you actually wear on your body?
Yeah.
That is a massive engineering leap, right? Going from integrating a system into a static car dashboard where you know exactly where the driver is sitting, to integrating it into a piece of apparel where the crash dynamics are infinitely variable. Why take on that engineering risk and rush into two-wheelers?
Because the physics of safety are the same. The engineering principles of rapid inflation, crash detection, and impact absorption, that's already in their DNA.
Yeah.
But the market dynamics, those are entirely different.
How so?
The traditional automotive airbag market is highly saturated. But the micromobility market, meaning scooters, motorcycles, and eventually e-bikes, it has historically had zero integrated airbag penetration.
Oh, I see. So they are taking a high-margin, mature technology that they have already perfected and deploying it into an entirely untapped vertical.
Precisely. It proves management is actively trying to expand their total addressable market before the core auto business enters a structural decline. If they can make wearable airbags the standard for motorcycle safety, they just created a multi-billion-dollar market out of thin air.
But before investors start pricing in scooter airbags to save the bottom line today, we have to look at the tangible macroeconomic headwinds management explicitly flagged for the remainder of 2026. Because operating a global supply chain right now is incredibly difficult.
It is. Michael Bratt, the CEO, made it clear that while customer call-off volatility has improved compared to late 2025, it stubbornly remains above pre-pandemic levels.
Let's break down call-off volatility for the listener because it sounds like corporate jargon, but it is actually the bullwhip effect in action.
Yeah, think of it as sudden changes in production schedules. You are a supplier. You have your factory lines fully staffed on a Friday, the machines are running, and suddenly the automaker calls and says, hey, we are missing a microchip from a different supplier. We have to halt production, cancel our order for airbags today.
Wow, just like that.
Just like that. But Autoliv still has to pay their factory workers. They still have to pay to keep the lights on, but they have no product to ship and bill for. Those unabsorbed fixed costs, they just destroy margins.
And on top of schedule volatility, there is raw material inflation. The earnings report noted that raw material price changes only had a small negative impact in Q1, about $5 million gross. But management is projecting a massive $90 million growth impact from higher raw material prices for the full year 2026.
Yeah, that's a huge jump.
How does management plan to absorb a $90 million hit without destroying that 10.5 to 11% operating margin guidance we discussed at the top of the show?
Well, they cannot just eat $90 million in cost. It requires an aggressive mitigation strategy. Management stated they expect to mitigate a majority of this headwind through internal cost reductions, material mix improvements, and crucially, commercial negotiations.
Commercial negotiations essentially meaning going to the automakers and saying, look, steel and nylon cost more today, so you are going to have to pay us more for this steering wheel.
Yes. And historically, Autoliv has incredible pricing power. Which brings us to the tariff situation, which is a great example of this. The new tariffs imposed in 2025 dragged Q1 margins down by 40 basis points. But Autoliv successfully achieved customer compensations for more than 70% of those tariff costs.
Passing 70% of a macro tax directly onto your customer is the ultimate proof of an economic moat. It proves automakers literally cannot build cars without Autoliv's components, so when Autoliv raises prices, the automaker has no choice but to swallow it.
It is a strong position, though management did warn there is uncertainty regarding future recovery levels. They estimate the tariff-related dilution on operating margins for the full year 2026 will be similar to the roughly 20 basis points they saw for the full year 2025.
Okay.
They also touched on a recent U.S. Supreme Court ruling regarding the International Emergency Economic Powers Act, which is basically a ruling regarding whether certain tariffs imposed in 2025 were actually authorized.
That sounds like it could be a massive regulatory threat to their cost structure. Are they exposed here?
It sounds massive, but management kept it very grounded. They explicitly noted they do not expect any material impact from the ruling. Their gross exposure is limited to around $25 million, and their net exposure, after mitigation, is well below $10 million.
In the context of $11 billion in annualized sales, a sub-$10 million net exposure is practically a rounding error.
Exactly. It is not a material threat to the company's financials, and they were really smart to address it quickly to calm any investor anxiety.
All right, let's bring this all together for you, the retail investor. Q1 was undeniably a messy quarter on the bottom line. The 12% drop in EPS and the negative free cash flow look terrible on a stock screener.
They really do.
But when you dig into the mechanics, the earnings drop was driven by R&D timing quirks and tough year-over-year accounting comparisons, while the cash flow bleed was just a working capital anomaly driven by a massive sales spike in March. Underneath the financial noise, Autoliv is executing brilliantly where it actually matters. They are capturing massive market share in Asia, specifically acting as the canary in the coal mine by winning contracts with domestic Chinese EV makers, and they are riding the wave of increased safety regulations in India, and they are doing all of it with a disciplined balance sheet that supports an aggressive stock buyback program.
And if we connect this to the bigger picture, this quarter raises a truly fascinating question about the future of the industry. As vehicle safety standards globalize and the core auto market stops growing, will traditional automotive suppliers like Autoliv inevitably transition into broader personal mobility safety companies?
That is the big question.
Right, because if a wearable airbag vest works for a motorcyclist today and a Yamaha scooter has an integrated airbag, what other booming micromobility markets could they capture tomorrow? Imagine the explosion in high-speed e-bikes or electric delivery vehicles in dense urban centers. If they can corner the safety market on everything with wheels, they really won't need to worry about stagnant traditional auto growth ever again.
Make sure you follow the show for your daily earnings coverage, keeping you ahead of the market.